Welcome. I'm here to introduce Krypton, a fully continuous, fully decentralized exchange designed to solve the hidden costs of trading. Our CEO, Michael Nowotny, holds a PhD in economics, but unfortunately he couldn't be here today. So my name is Arjun Goswami. My academic background comes from physics, but over the past 2 years, I've shifted my focus to the issues that Krypton is most eager to address, namely that of optimal trade execution and optimal market making within the DeFi space. So, first of all, let's just look at TradFi, right? Let's just look at TradFi. It's estimated that every single year, retail loses about $34 billion worth due to bad trade execution. And usually, this trade execution is against more sophisticated actors. You're talking about HFT, high-frequency trading firms, and algorithmic trading firms with the resources and the technical know-how to reduce latency. So if you, as a retail trader, just in TradFi, you want to sign up for a brokerage platform such as Robinhood or TD Ameritrade, what usually ends up happening is high-frequency firms like Citadel and Jane Street, they pay in advance for order flow. So you have very sophisticated market makers. So this is just in TradFi. So if you just look at the DeFi space, right? Specifically on the Ethereum network, there's a well-known problem. Well, it depends on your perspective whether it's a problem or not, but there's the well-known issue of minor extractable value or maximal extractable value. So this problem is even worse for your non-toxic traders, where privileged actors can collude with miners or engage in these toxic practices such as gas price auctions and reorder transactions within a single block just to front run your trade or sandwich attack your trade. There's also the issue of adverse selection where actors who wish to monetize, short-lived information about price increases or, price differences between other, exchanges, they're able to reorder transactions, and they're able to, use the Ethereum network in this toxic manner. So this is just so the problem is sort of even worse on DeFi. But so to quantify this, Krypton has carried out this internal research, and we've looked at this measure of we've looked at this measure that we call VPIN, the volume probability of informed trading. It's basically a measure of the imbalance of order flow, buying or selling versus selling or buying, to indicate order flow toxicity. And if you just look at the U.S. equities market, which is what this red line represents, this red index represents, you see that right before major dips, and particularly the flash crash of December 2008, there are spikes in this rolling measure. Right before every major dip, we see the spike in this rolling measure, and on average we see that it's about maybe 0.2, indicating that 1 in 5 trades, take advantage of some sort of advanced information. And in order to compensate for this, market makers have to increase their spread, and they have to demand fees and compensation. So now going back to crypto, okay, on centralized exchanges, the VPIN measure, it's not that bad. It's about half as much. It's about 0.1. But if you look at Uniswap V3, the premier decentralized exchange, VPIN is about 3 times as high. So, order flow toxicity is represented in about, 3 times as much as even traditional finance. So it sort of begs the question of why anyone would want to, trade on Uniswap or market make on Uniswap. Why any ordinary, unsophisticated retail trader, or or even just an LP would want to market make on Uniswap, where the only way for fair price discovery to take place is if the market maker is adversely selected against. And there's this huge problem of impermanent loss. There's this huge problem of asset pools which are loosely correlated or negatively correlated. DeFi has huge issues, and this explains why institutions. So, well, I'll get to that later. But this chart just shows like the losses due to adverse selection in the past year. And from 2021 to 2022, they're massive, on the order of So we see that institutions are basically shunning DeFi. Your most liquidly traded tokens, your Bitcoins, your ETHs, your blue chip stocks, just the DEX to SEX volume ratio is so off. We want to onboard institutions to decentralized finance. We want to onboard retail to decentralized finance, but we we see these issues, and so in order to solve this problem, we have to go to the root cause. We have to go to the root, the fundamental cause. And what's that? It's in the exchange mechanism itself. It's the discrete nature of the trading mechanism. When you transact value instantaneously, you treat the transfer function of quantity as a delta function in price and in speed. So it's a delta function. If you were to plot your, on the y-axis you have quantity or trading speed, and on the x-axis you have time. It's a delta function in the x-axis. Your time with the SO is pretty much 0, and you transact value instantaneously, and this leaves you vulnerable. This leaves you open to schemes where price can slip against you. Transactions can be reordered, and all sorts of basically shenanigans. So how do we actually solve this in practice? Well, this is a fundamental issue. It's like an economic issue, and so there's a solution from academia. This could be implemented on like stock exchanges. It could be implemented on centralized order books. It could be implemented, but it hasn't. So as Krypton, we have this unique value proposition that we are the first to implement this mechanism on a blockchain. And this is based on a paper by Kyle and Lee, the concept of a fully continuous exchange. Rather than transact value in the form of delta functions, we allow the value transaction to take place over a period of time as curves in the space of price and trading speed. And and if you think of traditional economics, you have supply and demand curves. On the y-axis is quantity, on the x-axis is price, and the equilibrium or the intersection is where market clearing occurs. So you can actually represent Krypton's fully decentralized order book in this way. It's fully decentralized, fully peer-to-peer, and the fundamental atoms of the order book are advanced limit orders. So if the price slips against you, if you're a trader with some short-lived information advantage to monetize, you will have to place an order at a higher trading speed in order for you to collect that value, and that will shift the intersection of these curves. So you will have to pay a higher price impact. So Krypton is a mechanism. It's an economic mechanism that allows fair price discovery to take place. It allows liquidity traders to not be traded against, to not have their, to not have toxic costs or just unnecessary costs just taken from them in trade execution, and it allows market makers also to make a profit. So we've done research on this. This plot basically shows a sort of risk and reward diagram. It comes out of theory. It comes out of a theory for like the probability distribution of stochastic processes for like a particular asset price. But it also comes out of a Monte Carlo simulation that we've conducted on our exchange, assuming that liquidity traders on our exchange arrive at the same parameters or arrive at the same, with the same arrival rate or size, quantity traded or size distribution as they would have on Uniswap v3, but instead they spread their trade out over time according to Krypton's optimal trading mechanism and optimal advanced limit order determination. So you see that if somebody wishes to transact value faster, on the expectation, if you look at this 50% percentile, on expectation, they would pay a higher price impact, but the variance is much lower. The tail end of these two confidence intervals are much smaller. But if you were to transact value at a lower speed, your price impact would be much lower than expected. But there is a possibility that that your trade has negative trading costs. So this high variance actually is optimal in a sense that you might even end up being paid to trade. So our market making algorithm uses linear quadratic control to keep a target inventory fixed and also fulfill the dual objective of maximizing profit and having the market maker staying at a particular target inventory. So this can also be visualized as an efficient frontier, a mean variance frontier of execution cost under these assumptions. So we have two academic papers. One of them is with a UCLA professor of economics. One of them is with our co-founder. You can read up on all the assumptions that we use. You could also visit our front end. We have a simple dashboard, which is just this really simple swapping interface. And we also have a complex dashboard that actually displays this fully decentralized order book that displays, these curves, the supply and demand curves in the space of price and trading speed, and made up of everybody's individual atomic advanced limit orders. And we actually have a very cool GPU simulation that shows the probability distribution of your implementation cost of your trade, assuming current market conditions persist. So this is the first proof of concept for this fully continuous exchange seen in the DeFi world. So please, when you have a chance, just take a look at our academic papers, take a look at our Medium articles. Please try out our beta. Yeah, thank you. Yeah.
Thank you.
Yep.